discuss behavioral economics. Decision makers often fall victim to systematic and predictable errors. Classical economics says that people know what's best for them, gather information, weigh it, and make the appropriate choices. But modern psychology rejects this perspective, which is ultimately the product of the Enlightenment of the 18th century. Specifically, my plan is to present some facts to you about the Trump economy and the Trump stock market, and then also to discuss how voters may look at these facts later this year. Chances are that a decade from now, the year 2020 will be remembered for the many deaths linked to the coronavirus. That 2020 will also be remembered for the protests, both peaceful and violent, in reaction to racial incidents like the recent police killing of George Floyd. That people will see the year 2020 as the start of a deep economic downturn with soaring unemployment, particularly among the youth of the nation. That 2020 will also be remembered for record low, zero or negative interest rates and a volatile stock market. And finally, that the year will be remembered for the outcome of the US presidential election. The outcome of the election in November will be determined by many factors, some having to do with domestic policy, others having to do with foreign policy, still others having to do with the personality and the temperament of the president himself. Here I will restrict myself to a discussion of the Trump economy and the Trump stock market. And my discussion will be behavioral, quote unquote. I will first show that even for experts, predicting what's going to happen in the economy or in the market next is very difficult to do. We live in a world, I repeat, of radical uncertainty. So how do voters then make choices among the incumbent president and his rival? Political scientists, since the days of Graham Wallace, Walter Lippmann, Reinhold Niebuhr, and Philip Converse, have suggested that perhaps the best theory of democracy that explains voting behavior is the concept of myopic retrospective voting. What that theory says is that what happens during the last year, even the last few months, is often critical in determining what people do in the end when they cast their ballots. And of course, here, what happens to people's pocketbooks matters a great deal. Now, as I go through my discussion, I will offer you a lot of facts. As Sergeant Joe Friday said, just the facts, man. And I think this is appropriate. As you know, the mainstream media with breaking news constantly work to shift our attention, the public's attention, from one minor psychologically compelling anecdote to another equally compelling minor fact, I think it is important, therefore, to remain calm and look at the historical evidence to put the data in perspective. I will use data today that go back all the way to 1873 in some cases. More often, I will use data that start in the 1950s and extend to today. The logic of behavioral research is to start from the brain, the psychological mechanisms that underlie cognition, emotion, and social psychology, for instance, or need for belonging, to move from these mechanisms to a series of decision traps, predictable mistakes, such as excessive optimism or, let's say, hindsight bias. In retrospect, everything looks obvious. And to move then from these decision traps studied at the individual level, to move from there to macro level distortions, mass opinion, herd sentiment, crowd behavior. In contrast, the Enlightenment tradition of rational choice assumes that people have well-defined preferences. They know what they want. They seek information, weigh the evidence, and then make the appropriate choice. This is the logic of consequences, where one always compares, for any decision, future costs with future benefits. But what happens when you don't know tomorrow? How do people, workers, consumers, investors, voters, how do they cope with radical uncertainty when the future is uncertain, when they are in fact overwhelmed by complexity? Many different things could happen. And to talk about voters now, let's remember that voters are busy people. They might not really be interested in politics all that much. And they might simply be incapable also of making up their own mind in a sensible way. What do people do? Often they extrapolate what happened recently and give it just too much weight. So extrapolation and overreaction is what we often see. Then with that comes overconfidence. People feel more sure about what they think they know than they really should be. There is also a great deal of wishful thinking. People confuse their preferences with their beliefs. And as they gather information, there is often willful blindness, information avoidance. When people do collect information, it may be simply to rationalize the opinions they already hold. Confirmation bias. Everything I've mentioned here so far, the different biases, nearly all of them have to do with distortions of beliefs, but others have to do with distortions in choice. People want to avoid losses, and so there will be extreme carefulness often to avoid any kind of loss. One way to avoid losses and regrets is to stick with the status quo, or to do what other people are doing. Here, identity and group loyalty is another useful shortcut, a heuristic, to handle difficult decisions. You just do what you've always done or what people like you tend to do. A couple minutes ago, I mentioned how some commentators have introduced behavioral elements into political science. Here you see photographs on the left of Walter Lippmann and on the right of Reinhold Niebuhr. Let me quote them. First, Lippmann. Early in the 20th century, he wrote, "Once you touch the biographies of human beings, the notion that political beliefs are logically determined collapses like a pricked balloon. For the real environment is altogether too big, too complex, and too fleeting for direct acquaintance. We are not equipped to deal with so much subtlety, so much variety, so many permutations and combinations." Interestingly, Walter Lippmann was an advisor to four Democratic presidents. He started out as a young man with Woodrow Wilson, then worked for Roosevelt, Truman, still later Kennedy. And here is a remarkable quote from Reinhold Niebuhr, who said that the will to power uses reason as in previous times. Kings used courtiers and chaplains, that is, to add some grace to their enterprise. In other words, it is not so much that men and women want to make rational decisions as they want to rationalize their behavior. They want to delude themselves and perhaps also others that they are justified in their judgments and choices. Enough theory. Let me move on to illustrate the important point that even the greatest economic experts, like this one, Alan Greenspan, the former chairman of the Federal Reserve System, not angelic, but still godlike, even the greatest expert knows little about what the future will bring. Here is Alan Greenspan, about two and a half years prior to the outbreak of the 2007-2008 financial crisis, describing a great victory of financial engineering. Greenspan said that the financial services sector has been dramatically transformed. Technology has enabled creditors to achieve significant efficiencies where once more marginal applicants would simply have been denied credit. Lenders are now able to, quote unquote, quite efficiently judge the risk posed by individual applicants and, note, to price that risk appropriately. These improvements, Greenspan concluded, have led to rapid growth in subprime mortgage lending. As I already said, what a victory. Stunning victory. I don't want to pick on Mr. Greenspan. It would be unfair. So let me quote his successor, Ben Bernanke, who said this in February 2008. "I don't anticipate any serious problems among the large international active banks that make up a very substantial part of our banking system." Now, of course, with the benefit of hindsight, we all know how all the major banks, in fact, had to be bailed out by the taxpayer. Of course, a few selected clips from unfortunate speeches prove very little. To allow an orderly assessment of the frailties of the judgment of economic experts, let me summarize a study put together by Dr. Andreas Kapler and myself. Kapler works at the Zurich Cantonalbank in Zurich, Switzerland. We examined data made available by the Federal Reserve Bank of Philadelphia. That bank has called upon well-known economic experts in finance, universities, industry, and government to make 7 and 13-month forecasts of the S&P 500 stock index. The forecasts are made sometime every June and every December, and they are for the end of the next June and the next December. So they are approximately for horizons of 7 and 13 months. This graph shows actual and predicted 13-month returns earned by the Standard & Poor's 500 stock index. The predicted returns are actually based on the medians of the forecasts provided by the 10 most senior experts in the sample up until every point in time. What we see is that the experts in red missed the bull market of the early 1950s. This is during the Eisenhower administration. Then also clearly missed the bear market of the early 1970s, 72, 73, 74, missed the strong performance of the market during the Reagan administration. Note how the green bars are much taller than the red bars. Then missed the extraordinary performance of the market during the Clinton years, subsequently missed the collapse of the internet bubble. This is around 2001, 2002, and so on. And then also completely missed the 2007, 2008 financial crisis. The forecast errors, which equal, of course, the difference between actual and predicted returns, are, as our president would say, huge. In addition to the median forecasts in red, this graph shows the disagreement, the divergence of opinion among the most senior experts. I show the maximum and the minimum. At any point in time, among these 10 most senior experts, the difference in predicted one-year returns can be as much as 20 or 30%, or even more. Even so, as you see from this graph, even the most pessimistic of the senior experts did not predict the collapse of the internet bubble around 2001. In this graph, Andreas and I plot actual S&P returns against forecasted returns. If the typical expert knows what he or she is doing, then we would expect that the regression line that is fitted to the observations would run through the point where the axes cross, would have a slope of +1, in other words, it would be a diagonal, and the dots would be close to that diagonal line. We don't see anything like that. What we see is that the regression line crosses the y-axis at about 12%. This indicates a systematic pessimistic bias of about 12% every 13 months. The slope is not positive equal to 1, it is slightly negative. Suppose it were flat. In other words, suppose the slope was 0, and of course it is close to that. Then the slope indicates that every prediction that the experts make amounts to nothing but overconfidence, because it would say that actual returns do not vary at all with the variation that we observe in predicted returns. Well, the result is close to that. Finally, we also see that the dots in no way come close to the regression line. So in every respect, this is disappointing from the perspective of rationality. In fact, the R-square of this regression is nearly 0, very close to 0. The correlation between actual and predicted returns is close to 0. This graph illustrates in a different way how little the experts know about the future of the S&P index. Here I plot absolute forecast errors on the x-axis, and then on the y-axis I plot the fraction of individual forecasts that are off by at least X%. So, for instance, 95% of the forecasts are off by 1% or more. You can see that perhaps 92% or so of forecasts are off by 2% or more. Consider now a forecast error of 20%. You will admit that's a large forecast error. Still, 30% of the experts' forecasts are off by 20% or more. Now, as I already said in my comments on the previous graph, it is much more common for these experts over the period 52-2019 to have been too pessimistic than to be too optimistic. So you see that the green area is much larger than the red area in this graph. But the main conclusion, the stunning conclusion, is just the magnitude of the errors. In a business, the investment management industry, where, so to speak, investment managers would kill for basis points, the experts can easily be off 10, 15, or 20%, and that is over a horizon of only 13 months. In a peculiar way, this cartoon also summarizes the previous result. You see a lot of expensive equipment in this cartoon, and we know from the previous graph that approximately half of all expert forecasts of the S&P result in absolute forecast errors equal or greater than 15%. Imagine, however, using something costless instead, a mechanical strategy that offers 13-month forecast of the S&P simply by always using the current level of the S&P. It turns out that this strategy also would have produced an average absolute error of approximately 15%. The mechanical strategy that I mentioned a moment ago implicitly assumes that at any point in time, the market is as likely to go up as it is likely to go down. And as we saw, such a forecasting concept does not demonstrably perform worse than the average financial expert. So this raises important questions. First of all, there is the puzzle of the appeal of expert opinion. Why does the press, why do investors pay such close attention to what the experts have to say? And one could add, why does this powerful appeal even strengthen further at times of great uncertainty? Question mark. Note, in addition, and this further deepens the puzzle, note that to some degree financial predictions may be self-fulfilling. If the experts say that the economy is going to collapse, that the stock market is going to tank, then these forecasts themselves may influence investor and consumer decision making. So to some degree, the forecasts shape market sentiment. Let us now look at the Trump economy and the Trump stock market from an historical perspective. To accomplish this task, I rely on data provided by the Federal Reserve Bank of St. Louis. I also use the macro history database constructed by three economists, Oskar Jorda, Moritz Schularik, and Alan Taylor. I rely on Robert Shiller's classic bestseller named Irrational Exuberance. And finally, I use some further data from Yahoo Finance. The period that I look at runs between 1872 and 2016. 1872 is right before the start of the second Ulysses S. Grant administration, and 2016 is the fourth year of the second Obama administration. Between 1872 and 2016, we have 144 years of U.S. economic history. This graph shows the average annual percentage change in real gross domestic product per capita, clearly a measure of economic growth. These are averages by presidential term, and there are 36 terms between the second Grant administration and the second Obama administration. The 144-year average is 2.01%. So let's round. It's 2% real growth per capita per year. High growth was realized during the Rutherford-Hayes administration, during the time of President McKinley, the first three Roosevelt administrations, then the period that Lyndon Johnson was in the White House. Since 1980, only the second Reagan administration and the second Clinton administration have achieved growth in real GDP per capita over 2.5%. The very big negatives occurred right after the great crash of 1929 during the Hoover administration, where the GDP per capita, on average, each year fell by 6 or more percent. And then right after the end of the Second World War, when Harry Truman was in the White House, and then we had a drop of approximately to 3.5%. Here I plot average annual percentage changes in consumer prices, again organized by presidential administrations. The late 19th century was characterized by falls in consumer prices. During the 20th century, we see outbreaks of inflation associated with war. The second Wilson administration, this is of course the end of the First World War. The fourth Roosevelt administration, where Roosevelt was succeeded by Harry Truman at the end of the Second World War. And then the aftermath, one could say, of the Vietnam War. Inflation was still moderate when President Lyndon Johnson was in the White House, but during Nixon, Ford, Carter, and early on in the Reagan administration, the pressures that had built up as a result of the Vietnam War led to big increases in consumer prices. Here is a third and final set of descriptive statistics organized by presidential terms. This time, the graph shows the 4-year cumulative nominal capital gains or losses of the stock market index. Note the extreme volatility during the 20s and the 30s, and also that since the second Reagan administration, that is since the mid-80s, the market has really performed very well. The only exception to that is the presidency of George W. Bush. But otherwise, since the mid-80s, it's been one giant bull market. The historical data on economic growth, inflation, and the stock market can be organized by party. When a Democrat is in the White House, the economy tends to grow faster. The difference is 1%. It is 2.6% versus 1.6%. When a Democrat is in the White House, stock prices also tend to rise faster. The difference is 7.7% per year versus 4.5% when a Republican is in power. But the story is reversed with consumer prices. Here, of course, the public wants less inflation, and that is where the Republican presidents deliver. When Republicans are presidents, consumer prices on average go up 1.1% per year. When Democrats are there, it's 3.5% per year. But one may ask, do these three variables actually influence voter behavior? Do they help to determine whether the party that holds the presidency is confirmed or replaced? The answer appears to be yes. On average, over the 4 years prior to a presidential election, confirmation is associated with higher growth in real GDP per capita, 2.7% versus 1.2%. Confirmation is also associated with better stock market returns, 8% versus 3% annually. Finally, confirmation is associated with lower inflation, 1.5% per year versus 3.1. It couldn't be clearer. These variables matter. So let's bring in Mr. Trump again and his record for the year 2017, 2018, and 2019 in terms of the three variables that I have mentioned. One may choose different benchmarks. Let me just compare Mr. Trump to the averages for the United States since 1873. This is the full data set that we have, since the end of the Second World War, and since the Reagan administration. I would say that whichever way one looks at the data, the Trump economy and the Trump stock market look strong. With respect to real GDP per capita, the Trump economy is just about equal to the long-term average, meaning the average since 1873. But it is significantly better than what has been achieved since 1945 or since 1981. The same story is true with respect to consumer prices. The inflation average is just about equal to the long-term average since 1873, but beats, in the sense that it is lower, beats inflation since 1945 and since 1981. Finally, let's look at stock prices. That is really quite extraordinary. The long-term average shows an annual gain in stock prices of 5.9%. Mr. Trump achieved 12.9%. I mentioned before how the stock market has really done quite well since 1981. And that led to an average return of 9.1% per year since that time. But clearly 12.9 is a lot higher than 9.1. The 12.9% annual growth that I mentioned a moment ago is strictly for the years 2017, 18, and 19. Here I show the full picture, starting on November 1, 2016, a few days before Mr. Trump was elected, and ending in mid-June 2020. Between that time, since November 1, 2016, up until mid-June 2020, the Standard & Poor's 500 has gained approximately 55%. As you see from this graph, the strong performance happened particularly right after Mr. Trump's election, let's say all the way until the spring of 2018. 2018 itself was a difficult year with a drop-off in the fall. But then 2019 was extraordinary in terms of its rise. Then, of course, more unusual things happened when the coronavirus came around. We had a precipitous, very steep fall in the S&P, rarely seen before, followed by a sensational recovery never seen in history of this magnitude over such a short time period. This graph repeats the analysis for a different index. The Nasdaq index is composed of smaller, more speculative firms, often high-tech. We see the same general pattern between November 1, 2016 and mid-June 2020, except that the returns for these more speculative firms were even higher. The index as a whole rose in this period by about 90%. In summary, the economy and the stock market have put Mr. Trump in a desirable spot. But do the events that happened on Wall Street over the last 3.5 years preordain the outcome of the 2020 election? Of course not. Perhaps the main imponderable factor is the economic effect of COVID-19. Even if the quick recovery of the stock market this spring seems to discount its importance. Here we see what the virus did to employment, or more precisely, unemployment. I show data going back to 1953 for the seasonally adjusted unemployment rate. Over this period, it's never been higher than 11% early in the first Reagan administration. But this past February, March, and April, it shot up to nearly 15%. Because historically, the unemployment rate has never dropped by more than 3% in 1 year, it is nearly guaranteed that there will be a great deal of gloom this November. And this negative mood may overwhelm whatever positive feelings are produced by the rise in the stock market. Paradoxically, the success of the stock market since 2016 and its recent surge may have come too early to do Mr. Trump much good in November 2020. To see this, let me go back to US stock market history and plot the performances, the stock market performances associated with all 36 prior presidential terms. In this graph, I show in black the median performance, and then I also show the blue performance associated with Trump, which is clearly beating the median performance. But I also show the best outcome over this long period. This is the line in green associated with the first Roosevelt administration. And then I also show the worst associated with Herbert Hoover. This was right before, the 4 years before Mr. Roosevelt entered the White House for the first time. Based on the historical data, it is easy to compare two scenarios. Scenario 1 is that the party that holds the presidency is confirmed, the status quo, in other words. And scenario 2 is that the party that holds the presidency is voted out. The voters switch to the opposition. Here I show the average stock market performance preceding either outcome. And what is noteworthy is that actually it is not the performance of the stock market over the full 4 years that matters. What really matters is the last 18 months, the last year and a half. Here in green, you see the average for scenario 1, which is that the incumbent party continues. And in red, you see the performance of the stock market when investors and voters presumably switch to the opposition. I have also included here in black where Mr. Trump stands at this point in time. A moment ago, I said that the two episodes in US history that showed the most extreme stock market volatility since 1872 are associated with Presidents Herbert Hoover and his successor Franklin Roosevelt. In this photograph, you see both men. They are on their way to Franklin Roosevelt's first inauguration. This was in March 1933. Herbert Hoover's term in office included the Great Crash of 1929, and Franklin Roosevelt's first term in office, right thereafter, after Hoover, included the very strong stock market recovery of 1936. Once we remove these two four-year terms from the full history since 1872, then, if we repeat the previous analysis, we get the outcome you see in this graph. It's not just that investors are myopic, don't remember much, are retrospective but only go back so far. It's not even 18 months, it's more in the order of 4 to 5 months. So what will actually matter if we want to predict the outcome of the presidential election by the stock market, what actually matters is the short period later this summer and early fall of 2020. Interestingly, the volatile markets of the 1920s and the 1930s also distort the conclusion that democratic presidents produce stronger stock markets than Republicans do. Here, once again, I show the performance for both groups of presidents over a 4-year period. And one is left with the impression, once again, that really the last 18 months make all the difference in this outperformance of Democratic presidents. But once Herbert Hoover and Roosevelt's first term are removed from the data, much of this evidence simply disappears. It is time to sum up. I have said 5 things today. First, I said that the future is radically uncertain, and that even the most senior public servants or economic experts have very limited forecast power. Secondly, I said that perhaps for this reason, many voters look back. They don't look forward, they don't try to predict the future, but they look back and they evaluate the record of the incumbent US president. They ask themselves whether they are better off than they were 4 years ago. In practice, they really think about what's happened over the last year or so, or even the last 6 months. Third, I said that there is very little doubt that the Trump economy and stock market look strong by historical standards going back as far as 1872. Fourth, though, I added to that in terms of the election outcome, what happens over the last few months is absolutely crucial because voters are myopic. Finally, I said that given COVID-19 and the surge in unemployment, and perhaps still other factors that I did not discuss today, the public's mood in November 2020 is uniquely difficult to forecast. And this leads me to one more final conclusion. That final conclusion comes with a quote of this man, Chris Wallace, a Fox commentator. 4 years ago, in March 2016, late in the evening on Super Tuesday, Chris Wallace said, "Lord knows I didn't think Trump was going to run. When he did run, I thought he had destroyed his candidacy half a dozen times. So I think that one of the things you learn is that you don't know as much as you think you know." That insight of Chris Wallace has been confirmed over and over again, not just in the election of November 2016, but in 17, 18, and 19. So let us protect ourselves against overconfidence. One of the things you learn is that you don't know as much as you think you know. To the viewers of this video, I say, like President Trump often says, let's see what happens.